3 days. That is how much time the President of the United States has given the Islamic Republic of Iran to reopen the Strait of Hormuz before he orders the obliteration of every power plant, every oil well, and the entirety of Karg Island, a 5-mile strip of coral off the Iranian coast that handles 90% of the country's crude exports. That deadline falls on the 6th of April 2026 at 8 in the evening Washington time. And this morning, while the markets waited for the non-farm payrolls number, while the United Nations Security Council prepared to vote on a Bahraini resolution authorizing defensive force in the Strait, while gold pulled back nearly 3% on whispers of de-escalation, silver sat at $73.75 per ounce, barely moving, like a coiled spring that has been compressed so violently and for so long that the energy stored inside it no longer registers on the instruments designed to measure it. Someone knows something, and tonight I am going to show you exactly who, exactly when, and exactly how much money they made while the rest of us were told to trust the market. This is OG John AG, no sponsors. No managed money narratives dressed up as independent research. No hedge fund talking heads who change their thesis every time their quarterly bonus depends on the opposite conclusion. Just the data, the delivery receipts, the timestamps, and the questions that should be on the front page of every financial publication in the Western world but are buried under ceasefire speculation because the answers would implicate the same institutions buying advertising on those publications. If you are new here, subscribe, because the information in this video has a shelf life, and by the time it reaches mainstream coverage, the trades will have already settled. Let me start with the scandal that Nobel Prize-winning economist Paul Krugman publicly called treason. On the 23rd of March, 2026, the Financial Times published an investigation showing that roughly 6,200 Brent and West Texas Intermediate futures contracts changed hands between 6:49 and 6:50 in the morning, New York time. 1 minute, $580 million in notional value. 15 minutes later, at 7:04 in the morning, Donald Trump posted on Truth Social that there had been productive conversations with Tehran about ending the war. Oil prices collapsed. Equities surged. The position was perfectly placed to profit from both movements simultaneously. Trading volumes for the S&P 500 spiked moments after the oil trade, meaning whoever placed those bets captured the upside on equities, while the oil short printed money on the way down. A senior trader at a major hedge fund told the Financial Times, and I will paraphrase carefully here, that in 25 years of watching markets, he considered the activity to be deeply abnormal. No data releases were scheduled that morning. No Federal Reserve speakers were on the calendar. There was zero event risk on the docket. Somebody just made an enormous amount of money on information that was not yet public. Senator Chris Murphy of Connecticut went further. He reported that $1.5 billion in S&P 500 futures were purchased minutes before Trump announced a 5-day pause on attacking Iranian power plants. Murphy posted publicly asking whether the trader was Trump himself, a family member, or a White House staffer, and called it mind-blowing corruption. CNN then reported that an unknown trader made $1 million on Polymarket from dozens of Iran-related bets placed through 8 newly created accounts, all registered around the 21st of March. The Guardian confirmed a parallel finding. 6 newly created accounts in February correctly bet that the United States would strike Iran by the 28th of February. They bought cheap contracts and cashed out when the bombs fell. The timing and sizing are publicly documented. The blockchain receipts are permanent, and no investigation has been announced. Now hold that in your mind. Hold the image of someone with advanced knowledge of a presidential war announcement placing $500 million in oil futures at 6:49 in the morning. And now look at what happened to silver on the 30th of January 2026, the day of the Kevin Warsh nomination. Silver crashed 39% from its January peak, the worst single-day performance since March of 1980. At the exact intraday bottom, $78.29, JPMorgan took delivery of 633 contracts. That is 3.1 million ounces of physical silver acquired at the precise lowest tick of the biggest crash in 44 years. CME delivery records are public documents. You can verify the contract count, the price, and the issuing entity. Investing.com published a full forensic analysis. Disruption Banking ran a detailed timeline. Felix Prain of the Goat Academy called it an engineered flush on camera. JPMorgan appeared to close its silver short exposure almost perfectly at the intraday low, an outcome that market professionals say is more consistent with coordination than coincidence. The same day the CME hiked margins. The same day the London Metal Exchange went dark. The same day HSBC's systems went offline. The same day a Reuters report claimed the United States was stepping back from plans to guarantee a minimum price for critical mineral projects, a story the Department of Energy later called false and deliberately misleading. If that retraction is accurate, then someone planted a story designed to trigger algorithmic selling in a market that was already in freefall. And the bank that paid $920 million in fines in 2020 for manipulating precious metals, Futures, was the one standing at the bottom with a delivery truck. But here is the part of the story that the conspiracy community misses, and it matters. JPMorgan did not lose on silver in 2025. Bloomberg reported that gold traders at the major bullion banks made a record $3.9 billion in profits that year, the strongest performance since 1979. The primary driver was not market making. It was arbitrage. When tariff fears pulled physical metal from London to New York, a price gap opened between the two markets. Banks bought cheaper metal in London, shipped it to New York, and resold it at enormous markups. The institutions that are supposed to provide neutral liquidity were the direct beneficiaries of the chaos. They did not suppress silver because they hate the metal. They repositioned because they are accumulating it. Estimates now place JPMorgan's physical silver stockpile above 750 million ounces. Much of it was acquired between 2012 and 2019, when silver was stuck between $14 and $20. They are not fighting the bull market. They are engineering the entry points within it. Every crash is a loading dock. Now let me take you to Rajkot, India. In the first week of January 2026, 44 silver trading firms officially declared insolvency, with combined liabilities approaching $425 million. These were not retail investors. These were institutional paper traders who held derivatives positions, not physical bars. When the CME raised silver maintenance margins to $32,500 per contract on the 7th of January, the margin calls cascaded through Indian commodity exchanges. Firms that had levered up on the rally to $121 were wiped out in hours. The physical market did not blink. If you hold a promise from a counterparty that is itself leveraged against a futures exchange that can change the rules at any moment, you do not own silver. You own a receipt that the casino can void when the house is losing. India imported $9.2 billion worth of silver in 2025, a 44% increase over the prior year, even as domestic prices nearly tripled. The demand did not care about the paper price. Now let me show you what is happening in the Strait. Before the war began on the 28th of February, approximately 138 vessels transited the Strait of Hormuz daily. On the 2nd of April, the Joint Maritime Information Center reported 12. Since the 1st of March, Iran has confirmed at least 24 attacks on commercial ships. War risk insurance was pulled entirely for the 5th of March, and now Lloyd's List Intelligence has reported something chilling. At least 2 vessels transiting the Strait have paid Iran directly for safe passage. The route runs between Iran's Keshem and Larak Islands, where the Islamic Revolutionary Guard Corps is verifying vessel details and collecting fees. One fee was reported at $2 million per transit. Market participants are calling it the Tehran toll booth. A French-owned container ship, the CMA CGM Kribi, became the first Western-flagged vessel to cross the strait since the war began, passing through Iranian waters late on the 2nd of April. Iran and Oman are drafting a protocol to monitor all transit. The waterway that was a free international shipping route is being converted into a toll road operated by a nation under active bombardment, and the country that started the war has told the rest of the world to deal with it themselves. Here is why this matters for silver specifically, and not just oil. The Gulf region produces nearly half of the world's urea and 30% of global ammonia. Roughly 1/3 of the world's fertilizer passes through the Strait of Hormuz. Urea prices have increased by 50% since the start of the war. The disruption of liquefied natural gas supplies is compounding the fertilizer shortage, hitting the northern hemisphere during spring planting season. The United Nations Food and Agriculture Organization has warned of a 3-month window before risks escalate significantly, affecting global planting decisions for 2026 and beyond. UN Secretary General Antonio Guterres appointed a special envoy to address the crisis, calling the closure a chokehold on oil, gas, and fertilizer at the most critical moment in the agricultural calendar. Foreign Policy published a detailed analysis on the 2nd of April, warning that the food crisis has already begun. Not at grocery store shelves, but at the level of farmer decision-making about what to plant and how much. If corn yields fall in the United States due to fertilizer scarcity, that affects beef, poultry, dairy, and processed food across the entire supply chain. And when food prices rise, core inflation does not cooperate with central bank projections. The OECD has already warned that headline CPI could jump from 2.4% to 4.2% later this year if energy prices continue climbing. The Fed's own March dot plot projected 1 rate cut for all of 2026, with core PCE revised upward to 2.7%. Those projections were produced before the full Hormuz impact was priced in. If inflation runs at 4% with the Fed frozen at 3.5 to 3.75, real interest rates go negative. And in a negative real rate environment, the punishment falls on anyone holding dollars while the reward accrues to anyone holding metal. Now the vault numbers. As of the 31st of March 2026, registered silver in COMEX approved warehouses has declined 13.1% over the past 30 days. That is 11.6 million ounces withdrawn. Paper silver claims, meaning total open interest multiplied by 5,000 ounces per contract, produce a paper leverage ratio of 7.6 times. The COMEX stress index reads 85. The all-time high is 88. The estimated depletion clock reads 139 trading days. The May 2026 contract alone shows potential delivery demand at 476.7% of registered inventory. That is extreme delivery pressure by any historical standard. And the metal is not reclassifying from registered to eligible. It is leaving the vault entirely. Seeking Alpha published an analysis in late February confirming that registered metal saw a large down move, and the metal did not flow into eligible. Instead, it left the building. London is mirroring the same pattern. The LBMA reported 27,065 tons of silver held in London vaults as of the end of February, a 2.4% decrease from the previous month. That is approximately 650 tons of silver that left the London vault system in a single month during a period of crashing paper prices. December 2025 produced 65 million ounces in COMEX deliveries, a single-month record. January 2026 followed with 49.4 million, more than 7 times what January 2024 had generated. All of 2025 combined settled 474 million ounces against 203 million the year before. The delivery volume more than doubled in a single calendar year without a headline event most people could name. But I do not serve you only bullish data. Your money deserves the bear case delivered with the same precision. The SLV ETF has shed over $3.6 billion in assets since the start of 2026. 6 consecutive weeks of outflows in the SIVR Silver ETF totaling more than $623 million. JPMorgan projects no rate cuts this year. A stronger dollar makes silver more expensive for every non-dollar buyer on Earth. If the war ends in the next 72 hours, if the April 6th deadline produces a deal, if the Strait reopens and oil crashes back below 80, the inflation repricing unwinds. Rate cut expectations return not from structural decay, but from policy relief. The excess metal that flowed into American vaults during the tariff arbitrage could begin flowing back to London, easing physical tightness. StoneX analyst Rona O'Connell has noted that scenario explicitly. And every leveraged trader who rode the 147% rally in 2025 without preparing for a correction is now a forced seller, not a willing one. You cannot dismiss the possibility that the paper price has further to fall before the physical market forces the reckoning. Anyone who tells you they know the timing is selling you certainty in a market that does not offer it. But here is what the bear case cannot account for. The silver market is running its 6th consecutive annual supply deficit. The Silver Institute forecasts a 67 million ounce shortfall for 2026. Total global supply is projected at 1.05 billion ounces, a decade high, and it still cannot close the gap. Industrial demand from solar photovoltaics alone consumed roughly 230 million ounces in 2025. The new generation of TOPCon and heterojunction solar cells requires 20 to 30% more silver per panel than the PERC cells they are replacing. Samsung's solid-state battery program, validated by Stanford research published in Nature Materials on the 16th of January, demonstrated that a nanoscale silver coating solves the cracking problem that has plagued solid-state electrolytes. Each 100 kilowatt-hour battery pack could require approximately 1 kilogram of silver. BMW is partnering with Samsung for next-generation evaluation vehicles in late 2026. If solid-state batteries achieve even 20% market penetration by 2030, analysts project 514 million ounces of new annual demand from the automotive sector alone. That is roughly equal to current total annual industrial consumption, added on top of it. China reclassified silver as a strategic material and tightened export licenses starting the 1st of January 2026. The country that shipped more than 4,000 tons of refined silver in the first 11 months of 2025 has pulled it behind a licensing wall with no sunset clause. BHP entered the largest streaming transaction by upfront payment in history, receiving $4.3 billion from Wheaton Precious Metals for silver linked to the Antamina mine in Peru. When the world's largest mining company monetizes its silver byproduct at that scale, it is telling you something about where it believes the price of that metal is going. And Sprott Physical Silver Trust doubled its at-the-market equity program to $2 billion in January. At current prices, that is enough to acquire approximately 18 million ounces of physical silver, representing roughly 16% of total COMEX registered inventory. A single institutional capital raise capable of absorbing 16% of the deliverable silver on the world's largest futures exchange. 5-day SLV net inflows just turned positive at $370 million, suggesting a divergence has opened between short-term institutional selling and longer-term accumulation by entities willing to buy the crash. So here is where you stand on the 3rd of April, 2026. The April 6th deadline is 72 hours away. The UN Security Council is voting today on whether to authorize defensive force in the Strait of Hormuz. Russia, China, and France have opposed the use of force. The resolution has been watered down from all necessary measures to defensive means only. Iran's foreign ministry has called the resolution irrelevant. A French container ship just became the first Western vessel through the strait since the war began. Iran and Oman are drafting a transit protocol that would formalize Iranian control over passage. Ships are paying $2 million each to cross through waters that were free 35 days ago. The global fertilizer supply chain is fracturing during planting season. Urea is up 50%. Airlines are cutting flights globally. Korean Air has entered emergency management mode. Kuwait's international airport was struck by Iranian drones. Pakistan has told its citizens to watch cricket from home to conserve fuel. Australia has reported fuel shortfalls at hundreds of gas stations. And $580 million in oil futures were traded 15 minutes before a presidential announcement by someone who knew exactly what was coming and has faced zero consequences. The spot price of silver says $73.75. The COMEX says 139 days of registered metal at current withdrawal pace. London says 650 tons left the vault in February. The delivery records say 474 million ounces settled in 2025, double the prior year. The industrial pipeline says solar, semiconductors, solid-state batteries, data centers, and artificial intelligence infrastructure have not paused for a single day of this war. And the institution that closed it short at the exact bottom of the worst silver crash in 44 years is now sitting on 750 million ounces of physical metal while telling its research clients that silver should average $81 this year. One of these numbers is lying: the paper price or the vault, the screen or the delivery truck backing up to a warehouse in northern New Jersey at 3 in the morning, the algorithm or the bar being loaded onto a pallet, stamped, serialized, weighed, and shipped to an address that does not appear in any public filing. When the April 6th deadline passes, when the strait either opens or does not, when the Fed either cuts or does not, and when the institutions that engineered the January flush decide they have accumulated enough metal at discounted prices, the snapback will not arrive with a press release. It will arrive in a delivery notice. It will arrive in a margin call going the other direction. And it will arrive to a market where 139 days of registered silver stands between the largest paper leverage ratio in modern history and the physical reality that the entire green energy transition, the entire semiconductor supply chain, and every solid-state battery prototype on every lab bench in Japan, South Korea, and Germany requires a metal that the world is consuming faster than it can mine, faster than it can recycle, and faster than the vaults can refill. If you made it to this sentence, you are not casual. You are not scrolling. You are the reason this channel exists. You read the delivery reports, you track the vault data, you count the bars leaving the building. You watched the January crash, and instead of panicking, you asked who was on the other side of the trade. That question is your edge. Do not let anyone take it from you. If this video earned your time, hit the like button. Share it with one person who still thinks the spot price tells the whole story. Subscribe if you have not already. And drop OG John AG 2.0 in the comments below. Not because the algorithm rewards it, because when the next viewer scrolls into this video and sees that phrase repeated 1,000 times, they know instantly that this community does not trade on headlines. It trades on data, it watches vault reports, it verifies every claim, and it stays until the last word. Invest with logic, never with noise. OG John AG, signing out.